Hello, pembelajar online whom I love wherever you are. So today we will talk about lease and purchase policies. But before that, please subscribe, like, comment, and also share my YouTube channels. My name is Dadang Prasetyo Jatmiko. I'm a PhD graduate from Cardiff Metropolitan University, and I'm also an expert in financial area. Please stay tuned. We will right back after this moment. Alright, ladies and gentlemen, so we will begin our discussion for today. Lease and purchase policy. Lease is a contract. In other words, the owner of the asset or the lessor gives another party, the lessee, the exclusive right to use the asset, usually for a certain period of time, in exchange for payment of leasing. Most of us are probably quite familiar with the term leasing a house, apartment, office, or car. In the last few decades, there has been tremendous growth in the leasing sector of business assets, such as cars and trucks, computers, machinery, and even manufacturing plants. The obvious advantage for the lessee is to use the asset without having to buy it. For the benefit, the lessee must fulfill several obligations. First and foremost is the obligation to make period lease payments, usually monthly or quarterly. Also, the lessee contract will determine who is keeping the assets under a fulfilled service or maintenance. Lessee, the lessor, pays for maintenance, repair, taxes, and insurance. But under a net lease, the lessee pays for the lease fee. Lease can or cannot be cancelled. If it can be cancelled, sometimes there is a penalty. Operating leases for office space, for example, are relatively short and can often be cancelled at the lease's option with appropriate notice. The term of these types of lease is shorter than the economic life of the leased asset. Only by leasing the space over and over again, either to the same party or to someone else, will the lessor be able to recoup the cost. Other examples of operating leases including leasing of copiers, computer hardware, word processor, and cars. On the other hand, finance leases are long-term in nature and cannot be terminated or cancelled over time. The lessee is required to make lease payments until the lease term is due, which generally correspond to the usual life of the asset. This payment not only changes the amortization or reduction in value of intangible asset, cost of the asset, but also provides the lessor with a return of interest. Finally, the lease contract usually specifies one or more options to the lessee at the time the payment expires. One option is to return the leased asset to the lessor. Then, another option may involve extension, where the lessee has the right to extend the lease term for another lease term, either on the same lease or a different lease, which is usually lower. The final option is to buy the asset which expires. For tax reasons, the purchase price of an asset cannot be lower than its fair market value. If the lessee does not exercise the option, the lessor owns the asset and is entitled to be residual value associated with it. As we will see, determining the cost of paying off the lease and returning it to the lessor is very important and depends on the salvage value of the asset. This is especially true for operating leases. So, we talk about form of lease financing. Almost all finance lease arrangements fall into one of three types of lease financing. The first one is sales and leaseback agreement, then direct leases, and the last is leverage leases, or the lessor puts up some of the money needed to buy the asset and borrows the rest from the lenders. In this section, we will explain these categories. Then in the next session, we will present a framework for the analysis of lease financing. Then we talk about sale and leaseback. Under a sale and leaseback arrangement, a company sells an asset to another party and this party leases it back to another company. Usually, the asset is sold at approximately its market value. The company receives the selling price in cash and the use of the economic asset over the basic lease term. In turn, the contract is paid periodically and gives title to the asset. As a result, the lessor realizes the residual value that the asset may have at the end of the lease term, whereas previously this value would have been realized by the company. The company can realize an income tax advantage if the asset involves building on owned land. Land cannot be depreciated if it is owned simultaneously. However, because lease payments are tax deductible, the lessee can indirectly depreciate or directly pay land costs. Lessors engaged in selling and leasing include insurance companies, other institutional investors, financial companies, and independent leasing companies. Then we talk about direct lease. Under a direct lease arrangement, a company acquires the use of an asset that it did not previously own. Companies can lease assets from manufacturers. IBM leases computers, Xerox Corporation leases copiers. Indeed, many company capital goods are available today as a basis for financing. The primary lessors are manufacturers, financial companies, banks, independent leasing companies, special purpose leasing companies, and partnerships. For lease arrangement involving all parties except the producers, the vendor sells the asset to the lessor, who in turn leases it to the lessee. Then we talk about leverage lease. It is a special form of lease is gaining popularity in the form of financing large assets, such as aircraft, oil, and rail equipment. This tool is known as leverage lease. In contrast to the two parties involved in a sale and leaseback or direct lease, there are three parties involved in a leverage lease. The first one is the lessee, second one is lessor or equity participant, and the third one is the lender. From the lease's point of view, there is no difference between a leverage lease and other types of leases. The lessee makes periods payment over the basic lease sum, and in return is entitled to the use of the assets. during the periods. The role of the lessors, however, forms has changed. The lessor acquires the assets in accordance with the term of the lessee arrangement and gains a partial acquisition by an equity investment of, for example, 20% or the term of equity participant, and the remaining 80% of the financial is provided by long-term lenders or lenders in general. Usually, the loan is secured by mortgage on the asset, as well as requests for lease payment and finance leases. The lessor itself then is the borrower. As the owner of the asset, the lessor has the right to deduct all depreciation costs associated with the asset. The cash flow pattern for the lessor typically involves: first, the cash outflows when the asset is acquired, which is the lessor equity participant. Second, the cash flow period represented by lease payments and tax allowance, deducted by debt payments, or interest and principal. And the third is the term of the net cash flow to the reduced taxes. The amount of lease payment and tax benefits also fell below the debt payment that had to be paid. If there is any residual value of the end of the lease term, this is of course a cash flow going to the lessor. While a leveraged lease may seem to the most complex of the three forms of lease financing we have described, it does reduce certain basic concepts. From the lease's point of view, which is a leveraged lease can be analyzed in the same way as any other types of lease. And then, evaluating finance lease in relation to the debt financing. Once the company has evaluated the economic viability of an asset as an investment and accepted or selected the proposal, the company should consider alternative methods of financing the investment. However, in making investments, the company does not need to own assets. The company in this case is basically interested in acquiring the use of these assets. Thus, the company may consider leasing the asset rather than purchasing it. In comparing leasing and purchasing, in cost of leasing an asset must be compared with the cost of financing the asset through the normal sources in financing, namely debt and equity. Since lease payments are the same as interest payments on loans and lease financing is equivalent to debt financing, financial analysts argue that the only proper comparison is to compare the cost of lease to the cost of a loan. Therefore, the lease financing decision, which is related to lease or purchase option, primarily involve a comparison between the cost of debt financing and lease financing. Evaluation of lease financing decision from the lessee point of view, which involve measures of net cash flow from purchase options. First, calculate the present value of the lease option's net cash flows. And second is decide whether to purchase or lease the asset or reject the proposal. Since many analysts argue that a lease financing decision is made only after the company has made a no-take decision on the investment, only a comparison of the cost of the lease and borrowing option. First, determine the present value of the after-tax cash outflow under the purchase or lease or borrow options. The second is compare the present value of the cash outflow between purchase or lease or borrow option. The third one is choose the option with the lower after-tax cash outflow value. So that's all the things that I can present for you today, and we'll meet again very soon. Assalamualaikum warahmatullahi wabarakatuh.